what is driving this rally? And obviously the smile on your face tells me that your own portfolio is in the pink of health. I'm sure your treasury fund manager, your equity fund manager is having a gala time looking at Bloomberg screens and notching up gains one day after the other. What do you think are the underlying 2 or 3 reasons for this rally that we are seeing?
Sure. So very clearly, one is India's absolute position. Second is India's position relative to the rest of the world. And I think third is the fact that we are finally getting out of the worst of the tightening phase as far as the global central bank action is concerned. So if I were to just elaborate on each of the points, see, India's inherent GDP growth rate is anyway somewhere between 5.5 to 7%. So even if it's 6% over the next couple of years, it still makes India one of the fastest growing large economies in the world. So the second point is that related to everybody else, we want the Indian economy to grow at 7 to 8%. But even 6% is a very good number in the global scheme of things, relatively speaking. So that's India's absolute and relative position. The second big thing that has happened in terms of India's relative position is that China is increasingly becoming a question mark and a cross for a lot of global investors. And we have a lot of global pool of capital which needs to be deployed. So the one of the very few markets which is fast growing and can absorb relatively larger pools of money is India. So in the last 3 or 4 months, we have begun to see that kind of shift also happening, which is money which would have otherwise probably gone to countries like China coming into India.
Mihir, chart for us a course for the next, say, 1 year or so. Inflows are actually getting thicker and fatter because the feeling of missing out is very high on the Lal Street. You'll be on a monthly basis deluged with cash. How do you intend to deploy this money which is coming in over the next 12 months or so? Sectors that you like, allocations that you would prefer, and where is the market headed 1 year from now?
Sure. So clearly, if the Indian economy grows, then the biggest beneficiary and the biggest driver has to be the financial sector, which is also a very large portion of the index. So a lot of the incremental money will go into financials. Within financials, we are still biased towards banking. But in the last 4 or 5 months, the differential between the private sector banks and the NBFC segment had opened up quite a lot. The valuation gap had become too much. So we have actually added some NBFCs to the portfolio, mid-cap as well as large NBFCs to the portfolio, because as we discussed, the funding tightening is past us, and NBFCs tend to do better when there's an interest rate easing cycle. Valuations had become very attractive versus the banks because NBFCs had outperformed. So within financials, we are probably biased a bit towards NBFCs compared to before. And of course, private sector banks remain the favorites.
Everybody that you meet on the road, in a party or at a dinner at your home, is having this intense feeling of missing out this super wonderful rally that we are seeing unfolding on the Lal Street. Given the corrections that often take place in these kind of setups, and some of them are sudden, how do you advise investors to navigate the next 3 to 5 years?
So 3 to 5 years is a very easy call. Stay invested and stick to your investment plan. Frankly, the difficulty is when you ask me for 1 or 2 months or 6 months. I think with a country like India, as long as you invest reasonably over a reasonable period of time, as we keep saying, it's kind of as we say, Gisa Pita phase, but very relevant. That timing the market is less relevant. It is time spent in the market that is more relevant. So I think staying invested for a long period of time is the only way you can really generate wealth, unless you have some superior insights like you.
Okay, and the final question, Mihir, where will this money go into? Would you advise maybe some kind of a exposure to the bond market, given that interest rates are likely to now soften from these levels? Or would you be a pure equity animal over the next, say, 24 to 36 months?
So it's really a function of, Asset allocation is a function of your age, risk profile, demographic profile, social responsibility, etc. So the younger you are, the more you would go into equities, and as you grow older, you would probably shift more towards fixed income. So it's a function of that. Plus, what are your short-term liabilities? If you have some expenses coming up in the shorter term, that money you probably will not put in equities. You'll keep it aside in a fixed income. So those kind of decisions one has to take based on one's requirements and profile. But as a thumb rule, the longer the horizon, the better it is for equities.